everyone for attending today. It's a pleasure to host you. Today we are in the 12th edition of this Market Action Pulse. It's been almost like it's been a year now that we've gone through this entire cycle. When we started out in July last year, I think the markets were just going through a time after tariff, and we were heading into a geopolitical tension area in India and Pakistan, and the 12-day Israel war. We've moved so much from there on. And it's just a pleasure that we've been able to kind of bring to you different insights during this particular time. Let's begin with, again, does anyone know that what are the four words that have caused investors the biggest pain, in investing? Like, what are those four words that investors just generally say that causes the maximum amount of pain? It's something that I think is out there. Would anyone want to take a stab at it? Yes. Yes. So in the chat is written. This has been the biggest thing, that this time is different. So this time is different are the four words that has kind of been the biggest pain causer for investors across time. Everyone looks at a particular event in a silo and thinks that this time is different, and hence one should kind of move that. To counter that, what we are bringing you today is basically another 5 words that you should remember, wish you were here before. Because while this time is different has caused pain, understanding that cycles and things which have happened in the past generally rhyme, bring you kind of a lot more sanity in the picture. And the thing that we keep on hearing these days is like, markets are topping out when they're going to crash. There's a number of things that will happen. So today's session we'll go through is that markets have always called the top too early. They've called the top on gold in 1979. They have called the top in technology companies in 1997. And they have called the top in commodities in 2003. And we'll take each one of those cases and learn through and bring out different perspectives on it. Again, before we start this entire session, a disclaimer, the CV disclaimer. First and foremost, any instrument that we show you here, there's no recommendation on it. Investments in securities markets are subject to market risk. Please read through every document that you can out there. There's no recommendation on any security that we discussed here today. If there is a recommendation on your client, and if there is a recommendation, it is already an action that we've taken place. Any performance that we show you today is past performance. Past performance is not an indicative of future performance. So keep that in mind before we start the session. Very quick recap of the last time that we were there, the last session itself. The last session, the biggest takeaway was basically we said the yields would start turning, and yields did start turning, and now they would kind of drive your investment decisions. So generally, this is what we discussed, that there is this dollar line, and this is there is this basically the dollar. Let's just move on to the right chart. That's much more simpler to understand. What we've done is basically we've taken the ratio of yields to dollar. Now this particular ratio was in a downtrend across time. What that means was that your yields were the lower factor, yields divided by dollar. The dollar was more dominating a factor, and hence your ratio kind of kept on going down. This ratio broke out in 2022 and has stayed kind of above that for a long period of time. That means that now yields have started dominating ahead of the dollar, and if yields start going up, we should at least the first thing that one should look every morning, rather than when look at markets are, look at where the 10-year is, because those will drive your any other decision. And secondly, basically our map, the last map we had, we said that in April, at the beginning of May, we were here. What we said was that we've sold in the weaker stocks here, and basically what we would do is that add in tranches between 23,830 to 23,525 to 23,200. This is where we'll add our conviction names. We've come down to this region now. This is how the market has kind of moved from there on, and we've added into it. We've said whatever whatever we said. There was some reserve powder that we want to keep till here. However, the news flows that we're getting right now, we don't think this should come. But if it does, there's a very least possibility of it, and we'll get there as well. Now, moving into the session today itself, we've taken 3 cycles from the past. Again, it is this. We wish we were there at that point of time, and we've tried to understand what was going on and try to learn anything that out we can from those particular stages in history. We're big believers of understanding financial history and trying to bring out whatever we can learn from there and apply that exact knowledge to today's world and decide where we want to move from here on. So the first, so basically just last month's report card very quickly. India, China are the ones which are struggling. US is kind of going up in a AI-driven world. Even in India, your mid caps and small caps are kind of outperforming the major indices as well. Looking at where the world is in terms of your forward and your lagging indicators, this is basically your macro indicators. If you actually look at it, there's just one forward indicator here, which is your PMI, Purchasers Managers Index. And in the world, the only place where Purchasers Manager Index is going up is basically India. So this has continued to remain strong. There's this particular reason that even though if India hasn't participated, given whatever the other news are, had this particular other news taken place some other time, let's say in 2008 or 2013 or something, would have fallen off the cliff. We haven't, and this is one of the reasons that the purchasing managers continue to be very positive about India. The future, the forward indicators look extremely good. In terms of GDP growth as well, we're the largest, with the fastest growing large economy out there. Inflation, when it was at 1.6 and 1% odd, when we were going through these math sessions, we said that is quite benign. There's no chance that it should stay there, and it should start coming up as well. And that is where we're looking at India in terms of, again, inflation coming back. But inflation is still below GDP as such, not pretty high, it's around 3.5%. This will continue to go up as well. We've taken all those cases and looked at it previously as well. In terms of what we want to take out, the forward-looking indicator in India, India is the only place where this forward indicator has gone up. Okay. However, obviously, this macro number is not reflecting in the market. That is the cause of worry everywhere. The cause of concern is what is driving. India's lost 2 places in terms of market cap ranking. We've moved away from being 5th in the world to 7th in the world, overtaken by Taiwan and South Korea. However, this is the headline number. When you actually look beneath the hood, Taiwan and Korea have run up only because of a few handful of names, right? If you in Korea, if you remove out SK Hynix and Samsung, the performance is not something to be looked at. In terms of in Taiwan, if you remove out Taiwan Semiconductor Company, your performance kind of drops again as well. Similarly, in Japan as well, if you strip out Tokyo Electronics and Advantest, you would kind of again be a very normalized place. In India, it's the opposite. If you actually take out the IT index, then your performance kind of improves. So that's the differential in the world. Having said all of that, we started this year with basically gold and silver spiking up, and a number of questions at that point of time that what place we should buy. We took this session on February, the first week of February, the first Saturday of February. We said we've sold into a manic rally. We think that it would continue to remain sideways. And in the last session itself, we said that, we are very constructive on gold. We also told you that any dips, we told you that dips would probably come, and that dips are reasons to buy and not to panic in gold. And the reason that we said that was basically, again, we believe that we are moving into a world where yields would go up. When yields go up, your bonds start to get out of picture. There's no point getting into bonds at all when yields have started going up. So there has to be somebody who has to take. So what does bond do in a portfolio? When you actually look at a portfolio and look at an asset allocation, your equity is supposed to be the one that should be the growing thing. And your bond is something that should protect you when things go bad with equity. Now, in a case where yields go up, so yields and bond prices have an inverse relationship. When your yields in bond yields go up, your bond prices start coming down. That means bonds start losing money. And we are in that world where yields are going up, so your bond prices will start coming down. You start losing money on bonds. So now bonds do not protect. So somebody has to take the place of bonds. And in that case, gold becomes the new bond. And that is what we saw. Again, this is exactly when, remember on the very first slide, during that time where your dollar and your yield trend line broke, during that time, another thing happened. Generally, gold is supposed to be correlated to the inverted real yield. That also decoupled and gold started behaving differently. Gold started acting like the new bond. And this is a very similar case of what happened in the 1970s. During that time, again, the inflation was rampant in the world, and the Fed chair back then, Paul Walker, had to raise interest rates like to almost 17-18% to break the back of inflation. We're not there yet. We don't know if we get there, but it is a cycle that is repeating. So what we did was we took the entire bull run of the 1970s, 1970 to the 1980 bull run, and we took the entire bull run from 2000, the beginning of the century, to till now, and then we overlapped it on top of each other. So this gold bull run, if you take it as a 30-year bull run, and you compare it to that 10-year bull run, and when you overlap it on each other, they kind of match. And with that matching, we presented a similar chart in February as well. When you pick that and when you zoom in, when you just look at the period that we are in, which is in 1979, according to different places that we are in. In 1979, also you had the Iran crisis, you had an energy crisis, you had a new Fed chair, Paul Walker coming in, you have new Fed chair coming in as well. So the macro script is also running, and in that script, even gold is running. So when we zoomed in that 1979 period, this is how gold kind of behaved. And using this as well at the beginning in February, we said that during the manic rally, we were happy to sell out because there could be a period of sideways movement. The sideways movement is continuing. It should continue for some bit of time, after which kind of you generally the continuation of that bull run happened back in 1979. This happened in 1979 doesn't mean has to happen today. There is a possibility it might not repeat. Generally, history does not repeat, it rhymes. You see exactly the chart is exactly not overlapping each other, but the direction is the same. The direction in the magnitude is also different. The last time the magnitude over here was from, so if we started from 100 on 2nd January 1979, you went up till around 375. So this is basically a 3.7 or 3.8 times movement. When we're trying to overlap here as well, the movement is actually slightly higher as well. So during the same time, the movement is very different. So once we discovered this about gold, we tried to replicate this in silver as well. And silver, while being a slightly more volatile entity, it generally has these weird movements. But during this time in 1979 as well, silver was sideways, and that is why we continue to remain not chase it. When we say we're not chasing it, any drop, because this particular thing also happened back in 1979, and given where we are macroeconomically today, we expect similar movement again to come through. So any dips in silver, gold continue to remain good opportunities for us at least, and that is what we kind of do. We saw yesterday evening as well that there was a global meltdown, and for the first time, I was kind of very happy. For the first time, I half believed what Donald Trump wrote on his Truth Social. So for the first time, I kind of agreed with what half agreed. Like, it's very difficult to fully agree right now with him, but half agreed. The reason yesterday the meltdown happened in the global economy was because jobs data came out good, better than expected. So when jobs data came out better than expected, you had the market participants now start fearing a rate hike, because your generally good job data leads to higher growth leads to higher inflation, and now Fed does not have the room to cut. They already did not have the room to cut. There are There are people who believe that Fed would have cut. We kind of have maintained that Fed has no room to cut. Uh, if they had any chance, yesterday takes that out of the picture. Now, with that, obviously, market participants start to feel the pressure. So Trump comes out and says that when job data is well, stocks should generally do well because your economy does well. This is the part that I agree with, and that is why any dips again over there, we are kind of very happy to lap that up. The second half is basically where he says that growth does not necessarily mean inflation. I don't agree with that because that is what the thesis runs on, that wherever we are heading to a very inflationary world. So with that, the gold and silver is kind of following the 1979 script or 1970 script. And with that, we are happy to kind of look at any dips that come through for a longer term period. Again, whatever we are kind of discussing, we're not discussing it for the next week. We're not discussing it for the next 14 days. We're kind of discussing it for months altogether. And for going forward, I think we are happy to keep some bit of asset allocation in gold and silver. That's how we're building asset allocation. Now that we started talking about equity, all that we kind of hear was that this is very similar to .com, and we agree, right? This is very similar to .com. If you actually go back and look at that time, people were working physically, writing down ledgers and all. The computers came and replaced a number of things. We've added onto it and added an whole entire intelligence layer to it. So it looks very similar to the .com, and that is why we kind of keep getting this question that when is this bubble gonna burst? When we actually went back and looked at the .com time, what we did was we took Netscape's release, the start of the .com bubble, and we've taken ChatGPT's release, possibly the start of, let's say, the AI bubble. And if we kind of overlay both NASDAQ and S&P on top of each other, they kind of again start matching out. And in that regard, the bubble, if you want to call it, is still midway. It's still far off that it's gonna burst. So again, the question that we kind of keep getting that, when is the dip coming? We don't. When is the crash coming? We don't know. But any dips, like something like this, where in the last event as well, or the last cycle as well, it kind of stalled, or you had this particular kind of dips. These are opportunities again to add on to a overvalued market, if you may say that. And when we say overvalued market as well, this is because the forward earnings were kind of quite low when we're looking at the valuation. But now the forward earnings have kind of picked up as well, and that is where what we are kind of looking at. And why do we think that this is 1997 right now and not 1999? Because there is a chance that this particular thing you can just overlap and bring it here as well, and then your general crash happened in your 1997. Similarly, your S&P as well, you can overlay in such a manner that this particular point may even coincide with this, and then a crash happens. So there has to be a reason why we believe that it is 1997 and not 1999. And the major concern that we kind of hear from everyone is because valuations are very high. What we think is valuations are still in 1997 zone. So when you look at companies that were dominating the .com bubble back in 1999, those were basically your networks company. So networks companies were basically the Cisco's and the tech companies. Basically somebody who was basically making a computer, who were helping with servers, who were helping with OSs and all. So the companies that were dominating at that point of time, Cisco, Oracle, Microsoft, Intel, those companies trading PE 1997 looked like this. So 18, 28, 49, 47, if you may. And in 1999, those trading PEs had moved up to 175, 125. So what that meant that between 1997, so in 1997, the earnings were still there. So earnings were the real one. By 1999, we had moved into a bubble territory where there was no earnings, but prices reflected like, the earnings were coming up. So when we compare it with today's world, the companies that are leading the AI race, NVIDIA, Google, Microsoft, Micron, those valuations look more like 1997, and it does not look like 1999. So right now the earnings are here. The only question is how long these earnings last. For the time being that earnings are lasting, there will be these one-off cases. Now, again, obviously, the rebuttal to this would be that Broadcom's result just came out like 2 days back, and that was the disaster as well. So you will continue to have these movements where a particular, if a particular movement is towards the NVIDIA chips or towards the Micron database or towards the Microsoft stack, then your Google stack will kind of start to suffer. And if it's towards the Google stack, then your Microsoft stack would start to suffer as well. So similarly, it's okay. It will keep on rotating between as companies kind of try to figure out which stack to move to. You will always keep having these rotations. But at this point of time, when you actually look at valuations, the valuations look more like 1997 and less like 1999. And hence the whole reason that we kind of believe that we are in 1997. And if we are in 1997, then the popping of the bubble is kind of very far off. And just talking about stacks as well, instead of chasing the past winners, understanding the AI stack makes a lot of difference. So basically, what we've seen till now is basically investments in chips, investments in memory. If you follow the AI stack, the next layer in that entire stack is basically networking and networks company, and along with that, data centers. And the final layer is basically your software and application companies. So this is the entire AI infrastructure in one small slide, if possible. So this is how we've stacked it together. Now, instead of chasing the NVIDIA, which people were doing at the beginning of this year, the smarter money moved towards memory. And that is how you've seen the memory cycle play out. There are certain issues with this as well. If you just keep following the stack as well, the idea is that the next stack would be networking, and you would want to start investing in networking companies as well. However, networking is a very fragmented business. So while chips, you have only handful, 2-3 companies making it. In memory, again, you have only 2-3-4 companies making it. Networking becomes a very fragmented play, the number of companies in the fragmented zone, and that is where kind of your issues start coming out. So instead of doing all of this, there is a particular play that comes out, which is basically all the AI requires right now, and AI can't run without data centers, and data centers can't run without power. The whole idea is just stay in power, which will kind of run through the entire stack as well. So that's a differentiated play. That's not an entire AI play, but it is interlinked to the AI whole stack as well. So talking about power as well, that is the bridge where your AI meets your physical world. So in India itself, we've seen that power demand or the power capacity kind of double, and then we're gonna double in the next like between now to 2036 is when we want to double again. So at this stage, both your capacities and your demand is kind of going up. So in that stage, right now we are at almost peak demand capacity. You may want to tell me that the capacity is much higher than the demand, so we should be safe. Well, it looks like that on paper, but when you say capacity is like 533 gigawatts, that means that you expect the plants to run 24/7 all through every day, running at 100% capacity. And then a number of these plants are basically your solar driven plants, which do not give you and the major demand peak is basically in the evening and the night. So the idea here is basically, while the numbers capacity looks quite good and your demand looks much lower, we be hitting almost 100% of the demand, and we're kind of having a lot of shortfalls. Wherever you are right now, you may see a number of power cuts already starting to happen. So we are kind of moving to a place where shortage of power is going to become much more, and because we continue to go towards the AI and the data center world. In that case, what happens is that the infrastructure is not built out in power, and that is what we kind of very happily wanting to kind of invest into. This is a very similar play to metals. When we started talking about metals like a year and a half back, very few people believed it. But the idea was the same, that 15 years of no investments in metals, when your AI world is dependent on chips which require those your critical metals, and you've had 15 to 20 years of no kind of investments in that. Similarly, there's another play which is basically that there has been no investments in power since for a long period of time. Very little people not looked at this particular sector, and a similar play could play out as well. So that is kind of while demand may look almost half of what the generation capacity is, we can't use the power generated in the day right now in the night because there is no storage capacity as such in the middle. Having said all of that, it leads us to commodities being still cheaper. Why? Because you need your metals for your AI to work out. So if the AI is in 1997 and there is a long runway ahead, your commodities right now are at a place where they're still cheap. So if you actually look at the 2008 high, so what we've done is basically we've taken the commodity index and divided it by the equity index, which is basically the S&P. So commodities divided by equities, the high was kind of reached in 2008. And then obviously nobody invested in commodities for 15. This is what I was saying, that nobody invested in for 15 years in commodities. So the ratio kind of went down. And now commodities is what is required to kind of power your next leg. And that is where your COVID low was hit. And then you had this 2022 high. Again, a COVID low retest. So again, it is quite cheap in terms of where we were in 2008. And this could kind of move up. So when commodities start moving up, we've already seen this. This is something that we took in the last session as well, and we've updated that chart and brought it here. In the last session, the orange line is basically your inflation line, and your blue line here is basically your commodity line. So in the last session itself, we told you that the commodity runs first and then your inflation follows. Commodity runs first and then your inflation follows. So similarly, at that point of time, this tick up in inflation was not seen. This is as of last month, so we're still falling down. But it looked like turning. Why? Why were we confident that inflation will be turning back? Because commodities have started running back up again. So now that commodities have started running back up again, inflation should start turning, and it is moving into to become a very inflationary and an expensive world. And the idea here is that all the while inflation's base is kind of rising. So the floor of inflation is rising, and that means that we're moving into a very inflationary world. Now, commodities are also, so in this breadth as well, commodities, we've seen gold follow the 1970 script. We've seen the AI and NASDAQ and S&P follow kind of the 1995 to 2000 script. In a similar place, commodities are also following the 2002 to 2008 script. In that case as well, this script is slightly more amplified. Why? Because the first up move in commodities, which was seen in the 2022 high, this particular move was much more amplified than what it was back in between 1999 to 2001. The correction also is slightly more amplified, and the pushback up should kind of be a very similar amplification of this particular script. So we've now figured out the three scripts that are kind of working all together: gold back in 1970s, tech in 1990s, and commodities in 2000s. What that leads to is, again, no surprises, that it leads to a very inflationary world. And inflation, when we actually kind of look at inflation over the last 110 years, inflation moves kind of in a cycle as well. So inflation has this weird cycle of 10 to 18 years, where if we start from 1917, right, it was down 15 years, and then you moved up another 15 years. Again, you moved down in 15 years. You went up 18 years, you went down 18 years, and similar, and so on. So based on that, generally, if inflation has around 10 to 18 year cycle, we expect inflation to be much higher by the end of this decade. And the reason why inflation is going to be higher, apart from what we've done, because right now what we've done is we have overlaid one cycle to the other. There are people who want to understand the reasons why inflation would be higher. The inflation would be higher on 5 counts. Deglobalization, which is taking place right now. The countries are moving more, want to become more self-sufficient in a way, because they've seen supply chains break across the world. Then this is probably the start. There are fiscal deficits which are running across the world. Defense spendings are going higher. commodity, as we just showed you, is moving into a super cycle, and labor is very difficult to come by. It's very tight in particular forms. So whenever this has happened, inflation kind of has started picking up, and that's basically the entire regime that we want to work on. So overall, all the three tell us just one thing, that we are moving into an inflationary world. When inflation comes up, so what does that mean? That means that your yield starts going up, your dollar starts coming down, your real asset starts going up, and bonds don't stand a chance as well. So you should. There's one thing that I see a lot of people, what this last 18 to 22 months has of sideways movement in the market has made people do is that they have become they've built a myth, or they've not started liking equities. They've started hating equities as an asset class, and have started moving into an asset class that would probably give them a fixed sort of return. So when that happens, and in an inflationary world, that fixed return is not going to beat your inflation, and you would actually be losing real money out there. So basically, a country that imports most of its oil, the super cycle should be very difficult to counter if you are invested in bonds. So that's the entire thesis in one go, and that thesis leads us to our positioning as well. The positioning that we've got this month is the same as last month. There is no reason to. We believe that there is no reason to break something that is working. There's no point going back and changing just because of the sake of changing. Two things rather that we would like to change maybe or look at going forward. One is basically our US allocation. We continue to add in dips, but we might just, given that we are still the runway is quite longer, we may just look to add again in tranches in dips rather than chase a market. We would continue to add in dips. And the other sector that we've been underweight on in India since like for 15, 18 months, we've been way underweight on IT. We've never held an IT stock. We finally think that as you move down your stack layer, Indian ITs would start again making sense, given that the valuation has kind of tapered off. So this is a question somebody asked like 8 months back, that have you started looking at IT sector? We said that at that point of time we did not want to look at it because we believe the valuations were still higher. We believe now valuations have become much better there, so we will continue to look at that particular sector. The sectors that we kind of the sectors that we kind of look at again remain the same: energy, metals, discretionaries, autos. We started to like even further now, so we may just add that more as well, and another pharma as well. We've kind of started to like in particular things. However, one thing that I want to tell you here is that in the metal space, we're not playing metals through through the index. The index of metals is kind of slightly. So if you're trying to play through Nifty Metal Index or an index fund, and we do know if index fund, but if you're playing through that ETF, we're not very sure about that ETF because that ETF has an issue in terms of the top 3 companies in that ETF make up almost 50% of that index, and that's something that we're not very comfortable with. So instead of that, we rather play it through either through an active mutual fund or through stocks directly. So we're not very comfortable with ETFs. But please remember that when you think about metals as well. These are a few sectors that we like and the reasons that we like it. Again, at the start of the year, we kind of continue to like these particular sectors. We've not changed much. And in terms of the ones that are driving it, probably we'll start looking at consumption a little more going forward, given that we are moving into an inflationary world. Maybe consumption companies will start getting better bottom line. When we looked at this, since the results season is over, we kind of looked at the results again. This is much better than what we had at last quarter, so we're kind of very happy doing it. What we've also done just last month itself, we told you that we've reduced our banks, and we've reduced it on back of good results as well. We don't want to kind of continue holding on because banks are clean right now. We've ridden the cycle. We've got better opportunities as well, given money is limited in certain times. So we would not want to go ahead and chase something where we've already picked up the bottom and gotten out on good results. What this eventually the question here is that what does this entire regime mean for India? And this we saw in the very first slide itself, right? Your Nifty did not perform as good as your mid caps or your small cap because the regime itself, an inflationary world, a country that imports 85% of its oil in a commodity cycle, it's a tax on the index, but it is a gift if you are in the right sector. So what we assume or what we think going forward, it will be more of a stock pickers market rather than a tide lifts all the boats together. If you are in the right sectors, which continue to work to make India better, India still needs a lot of infrastructure input to be able to compete in kind of those developed world markets. So those sectors which kind of continue to put India better on the map, we start liking them. Those which are dragged down by inflation, we obviously don't like them. And finally, the map this month itself, we are here. So last month we were kind of here. I think we were here. What we did was again bought through this entire thing, and we are expecting this particular supply zone. We don't think it holds, so we continue to hold it over here. Why we've gone in here because there's a very strong demand zone just sitting right below us. We were happy continuing to buy and looking to kind of ride through. We'll actually look at the zone between this supply zone and this very strong supply zone. Remember last time around as well, if you just go to the very first slide, we called this an interim demand zone because that did not exist at that point of time. There was just one supply zone and one demand zone. Folks who've continued with us in terms of would know that this zone did not exist. So we added an interim demand zone, and that is where kind of we're getting a lot of demand. So in that regard, probably between us, the supply zone and the very strong supply zone, an interim supply zone may appear. We will figure that out. And once we reach there, we'll let you know. We don't think that would happen in just one month or very few days. If it does, then we'll continue to let you know as well. In terms of performance, I know I've always run through this slide. I want to take one moment here. This is our performance for till in the last 38 months. We've continued to outperform our benchmark of Nifty 500. However, we've been validated of one thing that we wanted to do. For the second month running, our most aggressive portfolio has outperformed our most conservative portfolio. So over the 3 years, on an absolute return basis, our most aggressive portfolio is given 151%, while Nifty has given around 29%, and the conservative has given you 109%. So while this was there, over the last 2 years, that was the conservative that was kind of outperforming the aggressive. Over the last 2 months, in April and in May, our aggressive has started outperforming the conservative. So what that means is that now risk is being rewarded, and hence it validates what the regime that we are kind of moving into, where you have to take that extra risk to bring that extra return, else you're going to be eaten away by inflation. So that gets validated, and hence I took a little more time, else we continue to. Again, I've just told you the regime itself. The action is yours. We built this particular analyzer that analyzes your portfolio in less than 60 seconds. If you still require more assistance or want to talk to us, you can schedule a clarity call. I think Odisha can drop you a clarity call, Calendly message, book a conversation. We are happy to help you out, and opening up the floor for any questions that you've got. Thank you. Yeah, I know well, we've been right on time again, so that's good. 45 minutes of yeah.
So Karan, I have just one question. So basically, you were saying that the inflation thing, it's basically moving in a cycle, right? But I
Yeah.
also see like an attenuation layer to it as well. Like, so it's like the amplitude in the earlier years was like quite high. It was just going up and down very vigorously, while the amplitude itself right now it's quite reduced. So do you think that would also play into an impact on how much exactly the returns we can get actually? Because the point is that what do we exactly call an inflation shock would also be kind of dependent on that amplitude layer as well, right? So let's say like your inflation went up 20%, to went down -10% something, and now in this time it just goes around 2-3% up and 2-3% down. What's the impact of that?
Sure. So, thank you for the question, Tushar. So, if you're comparing this to 1970s, right? When you're talking about 18-20% inflation, you're probably talking about that particular time. In that stage, yields had to move to 18-20%. And it was kind of 1980s were slightly depressive in that nature because Volcker had to push yields really high. However, when you actually go there and look, the first push that Volcker did was in the 1980s, and that made the economy move into a recession. And as soon as it was going into the recession, yields again had to be brought in lower, just in 1981. And the minute he bought the yields lower, inflation spiked up again. So it was a very turbulent time, the 1980, 81, 82. We're not there yet, at least we're not there in terms of inflation, as you said, right? So probably you're right in terms of we may not hit 15%, we may not hit those 14-15% numbers. Where could we hit from, let's say, current inflation levels? Where do we go? A double as well. What difference is it right now is that you have this entire generation from 1990 to almost 2025, an entire generation that has not seen inflation, right? Inflation was at 1% or 2% or probably 0%, right? An entire generation that has not seen inflation. They are going to react very differently when inflation goes to 6% or 7% as well. The generation prior to that had continuously seen inflation for some bit of time. So it is how people would react to 6 or 7%, will kind of determine whether they cut back consumption or not is a big question. But yeah, we'll have to see.
No, that is fair. I guess, yeah. The human age factor that you added into it is
Yeah.
quite an interesting turn to it. Okay.
Thank you. Yeah, Odisha, you want to say
Karan, we have a few questions in chat. I can see something in chat.
something? Let me read them all. Uh, So yeah, Harshal, by real assets, what I mean is not just real estate. Real assets is basically something. So basically, there are two types of asset. One is the real asset, and one is the financial asset. Real asset is anything that you can touch and feel, right? A gold is also something that you can touch and feel. Silver is also obviously you can come back and tell me that gold is available in paper form and digital form as well, and I can't touch and see that. However, that is another reason that we like gold in physical form as well. So anything that you can touch and feel. When the world becomes expensive, the emotions of people generally move towards something that they can see. It gives them that benefit of achievement in a way, if you want to call it. And a stock paper is not going to give them the sense of achievement. But when the world is becoming inflationary, you want to kind of have something that you can touch and feel, which makes you think that you've achieved something. So that's what we mean by real assets. Real assets is something that is in physical form. Gold, silver, real estate becomes a entire domain of real assets. Um,
Hi, Karan. This is Tiash here.
yeah, hi, Chris. Tell me, how are you?
Thank you. I'm doing fine. Thank you. Thank you for such a wonderful insight. Pleasure to watch you, as
Sure.
always.
Thank you.
A couple of questions. In terms of, in dollar terms, we have been, our markets have been giving a negative return, and FIs, are loving to sell us even today. And we have enough reasons for that. So my question to you is that when we compare their affinity towards all the other Asian markets, emerging markets rather, whether it's Korea, whether it's Japan, or whether it's China, or uh, for that matter, other countries as well. We do not have any semiconductor or AI and chip, which is leading to that fancy returns. And similarly, the same drive goes on for US. Now, this is going to continue for a while, as you mentioned in the charts, that, okay, we have just in that 1997 scenario, and we have not yet reached that 1999 scenario. So in terms of, if I were to just talk about large caps, just the Nifty returns, shall we continue to see this kind of a negative return for for quite some time now? Maybe we don't know the definition of the time period, maybe 1 year, 2 years, we don't know. I mean, a lot of people have started assuming that since October 2024, where we last saw the peak of Nifty, and from there we fell. And now considerably, we are quite reasonably cheap. But is that just a reason to just give us a feeling that, FIs are going to come back and lap it up and we will see a dream run again? Or there is, I mean, this year and a few other, I mean, quarters going forward, we continue to languish because of the reasons which I just mentioned.
Thank you for that
Views
question.
on that.
Sure. Thank you for the question. Let me take the FII part first. FI has been continuously selling from 2022. We still saw that period between 2022 to 24 where the economy still or the market still did well. However, I'll take that rupee question or that dollar question. Let me ask this room overall, right? This is the beauty with data. Let me ask this room in general. How many of you think that rupee is under or rupee is losing ground? Like, I think if you keep reading the news, almost everyone out there is thinking rupee is losing ground. So yes, I'll ask you one question: how much should rupee depreciate in a year, like on a general basis?
Not beyond 2.7 to 3%. I mean, that's the trend for the past 40 years.
The general idea is generally 4% is what. Will you be okay with 4%? Like, general idea that I get is that it should depreciate by 4%. If it has depreciated by 4%, then we are kind of moving in the right direction. Would you say 4% would be fine?
Not too very sure, because for the past 40 years, the trend has been around 3%, because the abnormal movement that we that we witnessed this year and about a couple of years ago, where we saw 8% depreciation in a year and 9%.
Exactly.
So that kind of, has resulted in that deviation of mean, and
Sure.
it's gone up to 4%.
Sure.
But historically, it's been 2.7 to 3% is what I know.
Sure. Okay. We'll check with 3% as well. But generally the idea is 4%. Okay. So if rupee's been depreciating by 4%, then over the last, let's say, 6-year time period, if it's depreciated by 4%, we are fine, right? So if in April of 2020, if we were at 78, let's say, or 76 maybe, okay, and we have depreciated by 4%, then over the 6 years time period, we should be at 96, right? Which is where we are right now. The question is whether in 2020 April were we at 76. So let's find that out. Okay. So in April of 1970, we were at 76, right? And we're at 76, and then depreciation of 4% over 6 years time period, we should be at 96. Why does rupee feel weak right now? Because we had this massive period between 2022 almost to 2024-25 end, where rupee went nowhere. So during this time period, right? During this particular time period, which is a 2.5-year time period, the rupee was artificially kept very strong. And that is what in September 2024, if you had gone, the narrative was very different. We were one of the most strongest currencies out there, and hence you should buy equities, right? Now we are the weakest currency across the time. We should sell equities. That's the idea that has been given around, right? What has happened between 2024 to 2026 now is that the governor has changed. The previous governor thought that we should manage the rupee with the war chest that we have kind of built. The new governor at RBI thinks that market forces should determine the price of RBI of the rupee. Okay, so if market forces are to determine the price of the rupee, then they say that we should depreciate, let's say 3.5-4%, and then that is where rupee should. So this particular move in rupee, I believe, is market kind of repricing what we did here to come here, and exactly during September 20. This is your September 2024 when the narrative was basically rupee is very strong. It's the best currency in the emerging market stack. we should be buying equities. We have exact reverse right now, where we are the weakest currency and we should sell equities. So I have a very different view on the rupee. I think the rupee depreciation is we are fine between 92 to 96. Will we be 100? I don't know honestly, but we could go there. The other question is basically we don't have a AI company that you very rightly corrected me in saying that we don't have an AI player right now. We don't need an AI player, honestly. We have enough industrial and infrastructure to build first, then move to AI. It's just that FIIs love AI right now, and AI in terms of they've changed the current the particular sector or the theme itself, right? So in that regard, what solace I get is between 2022 to 24, FIIs were still sellers in the market and we were continuing to go up. What the problem was in 2024 September, and very rightly come out with a kind of call which was to move to cash in September 2024, was the valuation in India. We've corrected way much more from there on. The earnings have kept on growing, and those are the sectors that one has to target in. If you're just looking at the first 50 companies or the large cap companies, first 100 companies, let's say, in India, there are a number of players in the spaces that we've already loved, right? So those are the ones that we would target. We would not chase an AI player. We've kind of stayed away from IT because we knew that services would probably suffer from there on. So if you've played the sectors right, the returns have come through. Going forward, I think at least in the next year, we should come back at least to the long-term Nifty average of around 13% over a time period, 13 to 14%. And we are very positive about large cap, mid cap, and small cap.
So you believe that all the cap curves are going to deliver? For the past 2 years, mid and small caps, they did correct, but they're the ones who have again returned back to the investors, and they have become a darling for investors now. But
Yeah.
large caps continue to sell, and because they are heavily ETF driven, right?
Yeah.
And they have been owned by the FIIs, and so that's the reason. Even if you see fantastic results coming out, but there is a selling spree still going on, and it will continue to go on. So in that scenario, I was
I don't know
asking.
if it will continue to go on, and that's
That's
something
what we
that
have
we
been
have.
seeing. That's what we're seeing,
Yeah.
witnessing even today. So, which is why I
Yeah.
was asking you that between the
I
three
think that
cap
should reverse.
curves.
I think we should move towards our at least analysis and our models tell us that we should move higher from here. Is what we know, that there is certain bit of risk. We're happy to take that 4 to 5% risk for a higher upside. In the risk reward, we work with in large cap, we work with 3.5 to 1 risk reward.
Okay, thank you so much.
Okay, thanks. Yes. Okay, thank you so much. Again, I know it's just difficult. If you're following the news, it's okay to be scared. Our idea is basically to come back and give you the narrative that probably this time is not different. We've been here before. We've looked at a number of these rhyme and these cycles. They always kind of rhyme in certain ways. We still believe that any dips in real assets are positions to buy. We are positive on equities. We're not very positive on bonds at this point of time, even though those are the ones that a number of retail, again, bond at this point of time look like September 2024 of equities as such. So we're not very positive on it. In an inflationary world, I don't believe that one should be kind of put into fixed returning assets. So that's the idea. Apart from that, again, I think the team's given you the Calendly call. Happy to take any clarification questions, anything that you want in terms of your portfolios. Yeah, and do try out the analyzer. It just takes less than 60 seconds to figure out where your portfolios are. That's all from my side. Have a good weekend ahead. Thank you guys for attending, and thank you so much.